So I've actually been kind of struggling to put together a video over the past couple of days. Clearly, there's been a lot of chaos in the banking world with the Silicon Valley Bank imploding and a couple others as well. The Fed rushing to the rescue. Are we looking at bailout 2.0? Looks like we are. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate because it looks like we need a lot of realism these days. All right, today's March the 15th, right? Oh, the Ides of March. There you go. Hope you're doing well. So let's just get right into it. And again, I've been having I understand what's going on, and I wasn't going to rush to do a video because there seemed to be a lot of moving parts with respect to what was happening on Friday all the way through the weekend until Monday. So it didn't make sense to put videos out for the next day to have updates, etc. So I gave it a couple days and I wanted to see how things played out. And it's playing out all right, and it's already affecting the housing market, which is kind of interesting. So we'll go from there. So ultimately, what do we see people talking about is, oh my goodness, is this 2008 all over again, right? A major bank just went under, contagion is dragging down other firms, the Fed's introducing emergency measures to bail out the system. Is this 2008 over and over again, right? Well, this is kind of interesting. I think we'll see a lot of comparisons to where we are today going back to 2008. And remember, 2008, what did we have? We had a housing crisis that became a banking financial crisis that, basically became what was called the Great Recession. So it's almost like housing was the starting point of all this. It doesn't seem to be the starting point this time around. So, yes, in the sense that the Fed has created a massive bubble in risk assets. Also, yes, in the sense that banks made stupid decisions violating central tenets of risk management by lending money to clients who can never pay it back. However, that's where the similarities end because the issues the financial system faces today are far greater and systematic than the ones they faced in 2008. As they said, 2008 was triggered by a crisis in housing, which became a banking crisis courtesy of Wall Street's toxic derivative trades. This crisis in 2023 is a crisis in treasuries, which are the bedrock of our current financial system, the senior-most asset class in existence. And once again, Wall Street has gone bananas with derivatives based on an asset class. So in 2008, derivatives were based on what? Credit default swaps. Obviously, if you don't know what that is, watch the Big Short. They do a good job of explaining that. The market for them was roughly 50 to 60 trillion in size. Today's derivative markets are based on interest rates and bond yields, and the market for them is 500 plus trillion. So obviously, we can see that there's a little more at risk here, and a little more. There's just a little more out there that's going to make a big impact on what we're seeing here. So other debt securities followed suit, including mortgage-backed securities, corporate bonds, and the like. Again, as a result, the U.S. banks are currently sitting on $640 billion in unrealized losses on their longer duration bond debt portfolios. Not very good. Again, so enjoy the bounce we're seeing in risk assets now. Won't last. Just as the market was triggered by Bear Stearns' shotgun wedding to J.P. Morgan in March 2008, that didn't last either. So yeah, I think we'll see some interesting things happen in the next little while, but the long-term effects can be pretty devastating for the economy. There's no doubt about that. So what's happening right now? So if you're just an average person, or remember I can't use the word average, just a normal normie out there, what's happened? Well, obviously, a major bank has collapsed. That bank was Silicon Valley Bank. It was the 16th largest bank across the U.S. It catered to a lot of VC funds, a lot of tech startups in that area. So that's where a lot of money was flowing in and out of that bank. So what happened? There's a run on bank deposits, and essentially, banking crisis, run on deposits. It's going to affect savings, etc. For actual, we'll call it depositors, average people who have, or normies who have money in that bank. It's going to affect investments. I'm sure the stock market's going to go up and down based on what's happened here. The crypto market, that's going to probably have some ramifications as well too. I know that some of the depositors that were on the list in the Silicon Valley Bank were crypto-based either companies or exchanges, etc. Clearly, we're still having inflation, so how is that going to play out? That just compounds everything, right? Employment, well, when things go under and there's problems, people lose their jobs, companies shut down, etc. So employment's not looking good these days. Every other day on the news, I see various real estate companies or mortgage companies that are laying off workers. I see other workers in different sectors getting laid off. So the economy right now is not doing very well, and that will eventually trickle down to our focus, which is the housing market. So it'll be interesting to see how that will play out. I think we'll both see some short-term and long-term effects. I'll talk about that towards the end of the video, but I do think that this is a little interesting. It's different, right? As I said, housing started the issues last time around. I think this time around, well, obviously we know it's the banking that's starting the issues in the economy and the Fed, and we'll see, whether housing survives or how housing fares based on how that all plays out. So very interesting times ahead, guys. And again, I'm just using this as talking points here. Obviously, there's various people who talk about the economy on a much broader scale. I'm just using Peter Schiff just because there's Zero Hedge has a few articles out. I don't necessarily follow him or have a commentary on him, but he's got some interesting things here. So basically, as we start to sort through the fallout of the bank issues, the government reactions, what's next, what's going to happen. Government officials and mainstream pundits, which they've been doing all weekend, saying everything is fine now. They say quick government action averted a crisis. However, he's saying that this is the beginning of the next crisis. This is no longer the 2008 financial crisis. It's the 2023 crisis. It's been a long time, 15 years since we had a financial crisis. I'm surprised it's taken this long for the crisis to begin, but I'm not surprised we're having a crisis. And we all kind of knew that where things were headed, that something had to give. So essentially, the bank put in a loan program that effectively bails out any other bank that might be on shaky ground. This is the key too. So nobody wants to admit it's a bailout because obviously bailouts were not popular, and so they want to distance themselves from that language. But this is absolutely a bailout. Exactly. So who gets bailed out here? Well, you've got depositors are getting bailed out over the obviously there's the FDIC $250,000 limit. Depositors above that limit are getting bailed out. Other banks are getting bailed out, but I guess from people who are on the hook, it's going to be the investors in the bank, so the shareholders, stockholders, whatever. So government officials can plausibly claim they're not bailing out the failed banks because they're letting the institutions go under, but the bank's customers are getting bailed out. They would have lost money, but now they're not going to lose money. Why? Because the government is going to make up their losses. Biden and others also swear taxpayers aren't on the hook for this. So, okay, well, if that's the case, then where's the money going to come from? Of course, taxpayers are going to pay. May not pay in the form of taxes, but it doesn't mean taxpayers are not going to get away with this. They're going to pay for it, just that they're not going to pay for the higher taxes. They're going to pay with it with higher prices for virtually everything out there. So your banking fees are going to increase. Other things that you do are going to increase as well too. So eventually the money will come and go where it needs to go, and we're going to be on the hook for it, right? That's basically how things work out there. So this should come as no surprise. But again, it's not being labeled as a true bailout. That's language again. Now, my first thought was, okay, well, how did this go so far? So if you want to, you can do a lot of investigation, a lot of reading, a lot of articles on Silicon Valley Bank, on what they were doing, what they weren't doing, what their focus was. I'm not going to get into it here, but if you start reading that, you're going to go, okay, they sort of lost their way on this, and I think it's very typical for that environment, the big tech world environment, what goes on out there. It seems to all kind of make sense as to what they were focused on and doing and what they weren't doing. So top audit firm defends giving clean bill of health to SVP Signature Bank weeks before failure. So you're right. The question is, audit giant KPMG standing by its audits of Silicon Valley Bank and Signature Bank, which collapsed when customers rushed to withdraw their savings in a panic-fueled bank run. The two banks failed not long after the respective annual reports were certified by KPMG, one of the so-called Big Four accounting firms. A list that also includes Deloitte, Ernst & Young, and PricewaterhouseCoopers. So just a few weeks ago, you actually had, again, one of the Big Four audit firms say, oh, these banks, they're doing okay. They pointed to market-driven events and unpredictable customer reactions to such events as factors behind the bank failures. As we take into account everything we know today, we stand behind the reports we issued, and we think we followed all professional standards, said, a spokesperson for KPMG. They absolutely considered all the facts that were known up until the day of the audits were issued, adding that it's impossible to know with certainty what will happen after the reports are released. He didn't go into specifics of the cause of the twin bank failure, speaking only in general terms about actions and reactions in the context of bank runs. So, when you take a look at this, you kind of go, this has been the same thing the past couple of years. It basically is about narratives. It's creating narratives. It's putting red herrings out there. It could be basic lies as far as people are concerned. I mean, tell me that, 2 weeks, 3 weeks prior to this big bank run and having a bank virtually collapse, that nobody could have seen any signals that maybe things were not quite as stable as they should be. Like, you really have to not believe that. So what do we have going on here? We have probably a very big CYA, right? Cover your ass, essentially. So the Fed's doing it. Probably the employees are going to be doing it. These guys, the auditors are going to be doing it. So it's going to be a lot of finger pointing, a lot of we didn't know, or we couldn't anticipate things happening. The blame is a couple of VCs, sending emails out to people saying, get your money out of this bank and causing the bank run. I mean, that they're saying it was the social network and social engineering that caused the bank run in the first place for these guys. So, who do you believe and what do you believe? The point is that there's clearly systematic problems across the board, right? Again, the going concern warnings, they signed off 2 weeks for SVB and March 1st for Signature Bank. Questions have been raised as to why neither KPMG's 2 audits included so-called going concern warning, which would have been a requirement if the audit firm had substantial doubt as to whether the banks could survive over the next 12 months. So, of course, experts say that it's likely KPMG will face regulatory scrutiny over the audits. Common sense tells you that an auditor issuing a clean report, a clean bill of health on the 16th largest bank in the United States that within 2 weeks fails without any warning is trouble for the auditor. So that seems to make sense, right? So this is from the former chief accountant of the Securities Commission in remarks to the Wall Street Journal. So yeah, if you issue a clean bill of health and report and 2 weeks it implodes, something was missed, something was wrong, something was overlooked, or something was purposely not considered in the audit and not added or kept away from the audit. Simple as that. So again, SVP and Signature were the second and third biggest bank collapses in the U.S. Obviously, what people talk about is contagion risk. So how will this spread to other banks? So we certainly saw over the weekend that a lot of these smaller banks were trying to have people pull their deposits out and getting hurt, but apparently things got a little more stable as of Monday and Tuesday. So again, it basically is, the government stepping in to say what they need to say and do what they need to do to give confidence back into, I guess you could say, to the public, right? So I guess it's America's wake-up call. So, it's one of those things that you can see inflation's running, the housing market's kind of whack, and, stocks are always volatile, crypto's always a risk, but your own money in a bank should be safe. And clearly, this should be, shaking capitalism in the financial world to its core. This was an interesting chart. It's Silicon Valley Bank deposit funding. Essentially, you could see that their money, is, you can see where it's distributed. Only 7% are what we call private bank, which would mean normal people, with deposits. But a lot of the, early stage technology, early stage science, healthcare, international, global banking, etc. So there's a lot of money that's out. When you get almost 50% on technology, that's a bit of a, I guess you could say, risk factor. Who knows? But that's the way they've put everything into play here. So ultimately, in the end, that's where the money is. Now, the thing on the private banking side, the issue would have been, well, if you are a tech startup and you've got your banking and your money held that you received as seed money in this bank, well, chances are, and it was reported that a lot of people, have their own personal banking there and their own savings there. And, when you have these private banks and these, private portfolio things, these banks are doing mortgages for these tech people as well, too. So I can imagine that some people had some pretty devastating, pretty scary a couple of days of the weekend, wondering if they were going to implode and lose everything because of the situation of the bank. So, not a good scene for anybody, to be upfront. The reason we are now having another financial crisis, and it would have been a lot worse if we hadn't made the mistake of backstopping all these insolvent banks. But the reason they got insolvent was because of the government. The Federal Reserve kept interest rates at zero for 12 years. Then there was quantitative easing, and during that time, banks and pretty much everybody else loaded up on low-yielding debt. But in order to keep interest rates that low, the Federal Reserve had to create massive inflation. They called it quantitative easing, and the adverse consequences really started to show up last year when we had these big elevated increases in CPI. So yeah, so you know what, we're seeing inflation. We're seeing the inflation particularly still in housing, or shelter/housing, which they tend to use the rental rates, rental numbers for that calculation. So it's still going up as far as, maybe the year over year, didn't increase hugely, but it's still going up. We're not out of the woods yet. We're technically in a recession by definition, things like that. So that's what we're seeing out there right now. As I said, how do we figure this stuff out? It really puts you back on your heels when you kind of go, holy crap, every sector is getting hurt right now. All these institutions are insolvent at higher interest rates. We have a bigger debt crisis now than the one we had in 2008, which was also caused by the artificially low interest rates that followed the burst of the NASDAQ bubble when the Fed kept their rates at 1%. That inflated the housing bubble. But this time, 0% inflated a much bigger bubble. That's why we are now having a much bigger financial crisis. So ultimately, what Schiff was saying here is that the free market would have purged the economy from all these excesses a long time ago. And instead of having a bubble, we would have a genuine recovery with real prosperity instead of a phony prosperity that we've all enjoyed. And now the chickens have come home to roost. So yeah, I think we're all paying the price now for what's gone on. Essentially, is this rates or poor risk management? Low interest rates are what led to the excessive risk taking. And so did the moral hazard of the 2008-9 bailouts. Wall Street learned that you can gamble, and if you win, you keep the profits. If you lose, the government bails you out. So that was part of the reason for the risk taking, knowing that, hey, somehow, some way we'll get backstopped here. Basically, regulations encourage financial institutions to load up on treasuries and mortgage-backed securities because of the favorable way they're treated for accounting purposes. So they don't have to take any haircuts, they don't have to mark them to the market, and so the government policy has caused all this. But none of it would have happened had we not the 0% interest rates or the quantitative easing. So essentially, the press said we have to, no one's going to have to pay for these bailouts. He's wrong. We're all going to pay through inflation. Simple as that. So there you go. Inflation's destroying everybody's savings. So how will this affect the housing market? So that's the number one question here that we have to deal with. So essentially, like anything, when you have multiple financial issues going on across the economy, the broader based economy, it does pull it down. So as I said before, we had housing, banking, and bailout. Now we have banking issues, financial chaos, inflation, bailout, and that's going to affect housing. So there always is a normal drag down on whatever sector based on the other economy issues. So if one's strong and the other two aren't that's strong, that's great. But we're not strong in real estate right now with high interest rates and affordability issues. So housing market should get pulled down further, which in way is better for buyers, of course, paying less for prices. Again, it follows everything else, so it's traditional and it's just systematic how it'll go down as it's been going down. It's not like this has been up high and it's going to start getting pulled down. It already was falling in fall to where we are today. Sellers may move quicker to cash out. They may go, you know what? If the market's going to drop even farther, I better put my house on the market to cash out. Who knows? But the problem is buyers could be even more gun shy right now. They could go, you know what? I don't want to get into a larger mortgage or an expensive mortgage because I don't know where the economy is going. So that could be a factor for on the buy side. Lending guidelines will tighten up. So whenever there's a financial crisis, regardless of what it is, it's, again, as they say, it comes down to the average person to pay for it. So, you know what, you may not get that loan. Your pre-approval might get voided now, or what you thought you could buy in, as a house price point now gets reduced for reasons of risk. It's not your risk, it's the risk in the marketplace, right? So lending guidelines will tighten up, which means when they tighten, they always chop off part of the segment that could buy, they no longer can buy, all right? This will force a greater and faster price drop, typically, is what we see happen. So we'll see how that plays out. There'll be renewed interest in real estate as an investment. So one of the things I thought about was, okay, well, don't put your money in the bank. Okay, well, stocks are going to be volatile. Crypto, depending on how smart you are and where crypto's going, it could be volatile as well too. So people like the tangible asset, of housing because it's not virtual, it's not vapor, it's not, on your phone you can buy and sell, Bitcoin or whatever. Stocks, it basically, as you buy something, you can physically touch it and see it. So it probably resonates more with people. So you may see more interest in real estate as an investment. So a lot of money may be going out of some of those other markets into real estate. But again, it's not for the average buyer. It's going to be for investors. So that's going to maybe mess with the market. Who knows? We'll see what happens there. But again, it's because it's a tangible. It's because it's a tangible item, and we see that happening before. So, but again, I've already heard our real estate agents tell me in the past couple of days that they've already had some buyers that got their pre-approvals denied, or things have changed, rates have changed, or again, risk is up, so therefore you as a consumer are going to pay the price in a higher rate or larger down payment or different terms or whatever. So it's already happening, a couple days after this crisis occurred. So that's the thing. So housing market will still continue to fall. We'll see what happens. Anyway, guys, if you appreciate the information I provide, if you could hit that subscribe button, I'd love that. My channel always loses subscribers, so if you are subscribed, if you could resubscribe, that'd help us well too. So I'm not going to talk about anything else. I just figured this was enough to get into today. It's a lot to unpack. I'm not a financial wizard or economist by any means, but since the last housing crisis, I became quite schooled at how these things play and interplay together. So there's a relation there. It may not be the housing may not be the core. It will feel the core effect of this financial issues, but it's going to be residual for sure. We already have seen the market slide quite a bit since the fall, and I would see it sliding even farther and even faster as time goes on. And as I always mention, this is just on what's happening in the world today. There's no foreclosures being factored into what's going to happen in the future. So those are still coming. They will be there. They will affect the marketplace. It'll push us down farther than everybody thinks. So anyway, guys, again, appreciate the views, likes, and comments. Please share the video with your family and friends. If you want more information on my programs and stuff, please reach out to me. I look forward to speaking with you in a couple of days. See ya.